Joseph, the Lex column had some harsh words for Rocket Internet before it IPO'd. The German company is a kind of grab bag of minority stakes in global and unprofitable internet companies. We wondered whether it made sense as a public company at all. Well, now it's IPO'd and the stock is down. What do you think?
I mean, yeah, we did debate that, and you have to remember when we read the IPO prospectus, you know, you saw for the first time it has 114 or so fully consolidated subsidiaries, 195 not fully consolidated, stakes in 130 dormant companies, and like 29 legal entities accounted for at equity. So yes, very, very complicated.
And none of it profitable.
However, the point is now immaterial about whether it should go public, because it is public. The point is, well, it's now going to be a bellwether for a certain kind of sector. You can say that's, you know, European tech, this weird blend of venture capital and internet conglomerates more generally.
Or just extremely risky equities, right?
Yes, exactly. No profits. It's very, very speculative. But yeah, the fact remains it's public equity. However, as public equity on its first day of trading, it fell up to 14%. As we speak, it's now sort of down 5%. People got burned, but as a public stock, it therefore had one of the accoutrements that you have with an IPO, which is a price support operation from the underwriters.
Sure. So say a little bit about how that might have worked.
Well, you know, so this is just over €6 billion market cap company at the moment. There are about 150 million shares in the float, 33 million being sold today, and there was an over-allotment of just under 5 million shares. Now, if, as has happened, the IPO price sort of went below the offer price, or the share price went below the offer price as it did today, the underwriters, you know, who might have been sort of short that allotment amount, could then go back into the market and sort of buy back to cover that short
and support the price.
They could have done that. I mean, we're not 100% sure because they won't tell us until later on. But you can see from the stock price chart,
it sure looks like somebody has come in and supported the stock. So it looks then like the underwriters are doing their job in a difficult market.
I mean, if you are buying into this slightly unusual, let's put it mildly, sort of sector, you as an investor would expect that kind of after offering support. However, I mean, it's limited firepower. You want them to use that firepower, but however, that firepower can go down quite quickly. And we have to note here Zalando, which is this European online retailer, which IPO'd the day before, that clearly also must have had some kind of support because, you know, it went up 12%, then fell right down to down 8%, and there's clearly some price support going on. But the point is that the firepower quickly sort of runs out.
There's only so much the offering banks can do.
Yeah, and this is sort of the final point here, which is, yes, now that they have become public equities, this happens, and when it does happen, it can affect confidence. And that goes back to our original points, which are, is this stuff being priced properly in the first place, and should it be going public in the first place?
Thanks, Joseph.